These are the two sectors that made Indian families rich for decades. For 30 years straight, these two sectors were the safest bets in the Indian stock market. They gave consistent returns, steady dividends regularly with zero drama or volatility. Every traditional investor trusted them and built wealth through them. But if you are someone who has invested in these two sectors after the COVID, then you're probably regretting right now. While the market gave crazy returns, these two sectors left the investors crying. Just look at the chart, they have underperformed drastically. But there is a twist. So, this underperformance of these two sectors might be setting up the biggest opportunity of the next few years. And here's why I am making this video. After 2 years of underperformance, I am seeing multiple positive triggers.
हम नेक्स्ट जनरेशन जीएसटी रिफॉर्म्स लेकर के आ रहे हैं.
I am now happy to announce that there will be no income tax payable up to income of 12 lakh rupees.
The MPC decided unanimously to reduce the policy rate by 25 basis points from 6.5% to 6.25%.
Now, these triggers suggest that these sectors might just be ready for a major comeback and give good returns to its investors. So I am talking about the FMCG and the consumer durables, the bread and butter of traditional Indian investing. And the main goal of this video is to find out which are the good stocks in these sectors. And yes, we will also be talking about the positive triggers like the GST reforms, interest rate cut for 1 or 2 minutes. But the main goal or the main intention of this video is to find out that which are those stocks that we can keep on our radar and which stocks I am buying in my portfolio. So by the end of the video, you will understand exactly why this turnaround might happen and more importantly, which stocks are positioned perfectly to lead this recovery. So to understand which stocks will lead this rally, first we need to know that why these rock solid sectors suddenly became wealth destroyers. Now the answer is brutally simple. Consumption collapsed. Think about it. When inflation hits 7%, when your EMI interest eats up half of your salary due to high interest rate, when everything from petrol to onion costs more, what is the first thing that you cut? That new TV or AC, that premium shampoo, that branded biscuit, etc. For 2 to 3 years, the Indian middle class went into survival mode. And when people stopped buying, companies stopped growing. And when companies stop growing, their stock prices crash. But here's where it gets interesting. The government of India just fired 3 massive bullets to revive consumption. And if I am right, these could trigger the biggest sector comeback in years. And you as an investor can benefit from it if you hear me out till the end. Bullet number 1, the new GST revolution. On August 15, Independence Day, the PM dropped a bombshell nobody saw coming. The next generation GST reform. From multiple GST slabs to just 2 simple ones, 5% and 18%. And here's what it means for your wallet as a consumer. That 50,000 rupees TV you were willing to buy, today at 28% GST, that would cost you around 64,000 rupees. But after the reform, 59,000 rupees. That is a straight 5,000 rupees discount, not from the company, but from the government. And your daily FMCG products, here also the GST drops from 12 or 18% to just 5%. Suddenly everything from toothpaste, cooking oil to biscuit, everything becomes cheaper. And when prices drop, what happens? People buy more. And when people buy more, the revenue of these companies shoot up, and as a result, the stock prices also follow the same trend. Bullet number 2, the zero tax bomb. In 2025 Union Budget, the no tax policy of up to 12 lakh rupees was launched. Now add the standard deduction and you get 12.75 lakh rupees of disposable income or tax-free income. Now imagine a young couple, both of them are earning 12.5 lakh rupees each annually. Now that is 25 lakh rupees of pure disposable income hitting their bank accounts. No tax reductions, no government cuts. More money in the pocket equals more shopping equals higher company revenue, and higher company revenue equals, you know where this is going. Stock goes up, bullish. Bullet number 3, the interest rate cut tsunami. Jerome Powell just signaled Jackson Hole that an interest rate cut might be necessary due to weaker labor markets and inflation, partly driven by tariffs. And this might happen in September. And now everyone knows that whenever America sneezes, India catches a cold. When Fed cuts the rates, RBI follows. So lower interest rate means cheaper loans, and cheaper loans means that 3 lakh rupees car loan or that 25 lakh rupees home loan suddenly becomes affordable for millions of Indians. And when people can afford to borrow, they spend more. So to bring it all together, 3 bullet triggers, one massive consumption boom, and the sector that suffered the most is about to benefit the most and make a strong comeback. Now, here's where most of the investors mess up completely. They hear consumption boom and think, great, let's buy any random FMCG stock. But that is a disaster waiting to happen, because when demand explodes overnight, only the companies with serious operational muscle can actually deliver. And I have developed a 2 filter system that separates the winners from the pretenders. Filter number 1, production firepower. Simple question, when orders flood in, can they be fulfilled? So all of this comes down to fixed asset capacity. More factories, better machineries, higher production capabilities. So the companies who have increased their fixed asset capacity are the ones who can handle the demand. Filter number 2, trend intelligence. See, I have been tracking a seismic shift happening right now, and the health revolution is real. Everyone wants low sugar, high protein, no maida products. And the company who can deliver them to the consumers are going to get sold out from the shelves. So I ran every major FMCG stock through these 2 filters. 47 companies, hours of analysis, but 2 names dominated every single metric. And the first one is Nestle. Now here's what made me sit up and take notice. Nestle's fixed asset growth for years was steady, 8 to 10% annually. But the last 24 months, explosive expansion. It is like they're not just maintaining capacity, they are preparing for a war. Just look at their fixed asset growth. They have increased drastically over the last 2 years. But here's where Nestle shows that it is a genius. While competitors are panicking about health trends, Nestle is following the trend. Now, Cerelac, one of their most selling products, they have launched a sugar-free version of it.
टेकिंग न्यूज, फाइनली नेस्ले ने एक नया सेरेलैक लॉन्च किया है जिसमें उन्होंने रिफाइंड शुगर हटा दिया है.
And Maggi, they have not just reduced the sodium, they have launched multiple variants like Nutrilicious Masala Veg Atta Noodles, Nutrilicious Masala Oat Noodles, Veg Atta Spinach Noodles, Chicken Noodles, Fusion Range Korean Hot Maggi. So business-wise, Nestle is making changes as per the changing market dynamics. Now let us talk about the valuation. Nestle has always commanded premium pricing. Historically, it has traded between 75 and 90 PE. Why? Because market dominance, brand power, pricing control. But here's the opportunity. After 24 months of sideways movement, the stock is trading near the lower end of its historical PE band, which is 75. And my analysis says that Nestle is trading at 16% discount from its peak. So valuation wise as well and price discount wise as well, it is a very attractive zone. Now technically, the stock is riding its upward trend line support. And if the stock sustains above this line, it is a good accumulation zone. And the key support level to look out for is 1070 rupees. So fundamentally as well as technically, Nestle is looking like a good stock with a long-term perspective. Now I have something which most of the people do not understand. Nestle is just the beginning. While I was running my analysis, another FMCG stock caught my attention. A company that has been quietly building an empire and most of the retail investors do not know about it. A company that has shown strong price growth over the last few years. But here is the crazy part. After the recent market correction, the stock is available at the biggest discount. So the fundamentals absolutely bulletproof and the growth trajectory unstoppable and the valuations ridiculously attractive. Now I was going to reveal it today, but that company or that hidden FMCG gem deserves its own deep dive analysis. So here's what is going to happen. Part 2 of this video comes out very soon. In that, I am going to break down the hidden FMCG gem, the company, the numbers, the opportunity, the everything. But if you are not subscribed with the notifications on, you are going to miss it. And trust me on this one, you do not want to miss it. Because while everyone's chasing the next shiny object, the real wealth is being made in these forgotten sectors. And this stock, it might just be the biggest opportunity hidden in plain sight. So hit that subscribe button, ring the notification bell, and yes, do not forget to comment and let me know which FMCG stock are you holding in your portfolio. So see you very soon in part 2 where we uncover the hidden FMCG gem that nobody's talking about. Bye bye. I discovered amazing undervalued opportunity. It gives 6-time returns in just 5 years with constant growth in its sales and profits every year with amazing profit margins. And this stock has huge potential and I am going to reveal this hidden gold mine in this video.